September looms large on Wall Street. If historical patterns hold true and the beginning of the month was an indicator of that, we could be facing a challenging month ahead. But even Winston here knows volatility breeds opportunity. Felix here, and today I've identified 3 stocks from diverse sectors that warrant close attention. These are not your typical tech darlings, but established players with intriguing potential. We'll examine their financials, recent performance, and why they might present compelling entry points if market turbulence continues to materialize. Speaking of opportunities, our teaching portfolio has seen a remarkable 80% gain this year. That's a 24K gain on a 30K teaching portfolio. If you're curious about our methods, I'll share them with you completely for free. All you got to do is head over to felixfriends.org/webinar, grab yourself a seat for our beginner trading training this coming week. And now, before we dive into these 3 specific stocks, let's briefly examine which sectors tend to face headwinds during economic uncertainties. This context is crucial for identifying potential opportunities. So historically, certain sectors have shown greater vulnerability to economic downturns and the so-called September effect. So these vulnerable stocks typically include consumer discretionary, think luxury goods and automotive stocks. Technology, particularly semiconductors and software companies. And 3, travel and leisure. Airlines, hotels, and cruise lines often feel the pinch. 4, financial services. Banks and investment firms can struggle during economic uncertainty. And industrial companies, manufacturing and construction, may see reduced demand. It's important to note that while these sectors may face challenges, they can also present compelling buying opportunities for the astute investor. Well-managed companies with strong balance sheets often emerge stronger from periods of market turbulence. And this brings us to our 3 stocks of interest. Each represent a different sector we've just discussed, and each has a unique characteristic that warrants our attention. So let's start our journey with an airline company. Delta Airlines, a company that's weathered some of the most turbulent times in aviation history. And I'll tell you at the end of each whether or not I would actually buy them. Now, cast your mind back to 2020. The world ground to a halt and Delta's stock plummeted to $19.19. Fast forward to today, and we're looking at a stock price hovering around $42. That's a 119% increase, not too shabby if you consider the airline got hit right in the face during the pandemic. And let's dive deeper into the numbers. In the last quarter, Delta brought in $16.6 billion in revenue. That's a 7% increase over the year. Now, you might be thinking only 7%, not exactly setting the world on fire. It's not Nvidia, is it? But take a look at this. Delta is not only flying more passengers, they're flying smarter. Their gross profit margins have been on an upward trajectory, reaching 27% in recent quarters. That's a far cry from the digit margins we saw during the pandemic. And that improvement isn't just about selling more tickets. Actually, Delta's been overhauling their operations, introducing more sustainable, systems, and therefore able to cut costs. But let's talk numbers. Profits, to be more precise. Delta's diluted earnings per share have swung from a negative $1.48 to $3.17. In the most recent quarter, it was $2.68. Again, not too bad. So it's a very, very nice turnaround story. But the billion-dollar question is Delta's recovery complete, or is there still room for growth? With international travel still rebounding and business travel slowly picking back up, there could be more altitude to gain here. But there are headwinds. Fuel prices remain volatile. Economic uncertainties could impact travel plans. Plus, a year-to-date return of just 4% might not be super exciting. So what about the stock price? Currently trading at about $42, it's about 10% below its 52-week high. But while Delta's had a bumpy ride, it's still outperforming many of its peers. The company's year-to-date returns might only be 4 to 5%, but that's against the backdrop of an industry-wide challenge. So you might be wondering, Felix, but there's a lot of sort of news in here. What's the opportunity? Well, let's dig a little deeper, shall we? International travel is still in recovery mode. More routes opening up, demand's increasing, and Delta's network is pretty extensive. could be an advantage. The recent partnership expansions in Europe and Asia are also positioning them for potentially more future growth. And then there's business travel. While Zoom calls are here to stay, face-to-face meetings are making a comeback. Delta's premium offerings and loyalty programs do make it a top choice for US corporate clients. So as business travel rebounds, Delta could see a nice boost to its profit on the bottom line. They've also been working hard to reduce their debt load, which ballooned during the pandemic. They've made pretty good progress on that, but there's still some work to be done here. So what's the verdict? Well, there's some challenges here. Fuel costs, economic uncertainties, and debt. But they also have some aces out there. It's a pretty decent brand, improving financials, potential growth, and travel might just pick up again. So the question is Delta stock ready for takeoff and ready for our portfolios? Well, that depends a little bit on your investment horizon and your risk tolerance. Now, if the current price dips nicely, it could just be an opportunity if we go into a particularly dodgy September here. But there is a warning that I learned from a friend of mine who happened to be CEO of a very, very large airline, one of the largest in the world. And he explained to me this, and he said, Felix, the airline business is pretty much unlike any other business. And that's because if you sell a phone, a Samsung, you know you're going to make, you sell it for $1,000, you're going to make $500 profit. You know exactly your profit, right? You sell pretty much anything else, whether it's a pen or a bottle of Coca-Cola, you know how much money you're making. As an airline, you don't. I open a new flight, you buy a ticket, you pay me, $500. At this point, I'm losing millions of dollars because I haven't sold any other tickets. So I'm offering a product that's potentially very, very loss-making unless I can fill the rest of the plane. And possibly I even have to fill the cargo department to actually make some money. So it's a very, very hard business to run because it's very hard to predict those things. And adding extra capacity could be the one thing that loses you a lot of money. And then input costs are super variable, oil prices and everything else. So it is one of the most challenging businesses out there. And I kind of think without continued government intervention, it probably wouldn't exist. I don't think as a business, an airline really makes a great deal of sense. So the reason I wanted to throw this in here, because I think there's a lesson in this. And yes, there are airlines and their stocks go lower and higher. And if you buy it at the bottom of a dip, the midst of a recession or a pandemic or something, you probably make some money. But you would have also made money buying pretty much anything else that as a business is just easier to understand. So I always like to buy things where I can understand how they're making money. And my mind is fairly simple. So I can understand how these guys make money. They sell this. I know what the margin is. And therefore, I know how much money they're making. If they sell more, brilliant. If you're a software company, you're Microsoft, I pay you $100 subscription a month. You're keeping $90 of that as profit. And you got like a $10 delivery cost, basically. So those businesses are just easier. So I would personally stay away from airlines. There is a very nice Warren Buffett clip. Type in Buffett and airline after you watch this video, and there's a very funny clip, which he has a bit of a problem with airlines, and he talks himself out of it. Now, from the soaring skies, dig a little bit deeper into the earth, and here is a company that's called Caterpillar Inc., the world's leading manufacturer of construction and mining equipment. These guys are everywhere. They have these yellow machines in more countries than you can shake a stick at. And let's dig into the numbers. So their revenue has been on a steady climb. In Q2, they brought in $16 billion in revenue, not exactly a small outfit. And their gross profit margins have been expanding faster than a hydraulic piston, reaching a robust 35%. Pretty impressive for someone making stuff. What about profits? Their diluted earnings per share have been climbing steadily, reaching $5.48 in the last quarter, which is very, very impressive. And the million-dollar question for Caterpillar is Caterpillar's growth sustainable, or are they building castles in the sand? Well, global infrastructure needs are on the rise, and potential US infrastructure bill being in the works, there could be a lot more fuel in the Caterpillar's tank. So what about the stock price? Well, like a well-oiled machine, CAT's, that's the ticker symbol, CAT stock has been steadily climbing the charts. Currently trading at around $339, they have bulldozed their way to a 16% year-to-date gain. But the real question is, has this heavy machinery giant built a solid foundation for future growth, or is it a bit shaky? Well, the broader market has been stuck in neutral. Caterpillar has, however, been firing on all cylinders. The 12-month return is about 20%, and a steady, progressive 5-year return of 170% have left many investors purring with satisfaction, like one of those big, beautiful yellow machines. So what's fueling this? Well, it's kind of the perfect storm. Global infrastructure needs are surging, particularly in emerging markets. And the mining sector is experiencing a renaissance driven by demand for metals crucial to green technologies. Think, Elon's Tesla and so on. And they have a dominant market position in construction and mining equipment. And it puts them basically in the driver's seat to capitalize on all these trends. And they're not just selling machines, they're selling solutions with a growing focus on autonomous and electric vehicles that could reshape the entire industry. But let's not get ahead of ourselves. Like any good construction project, we need to inspect the foundations. Caterpillar's diverse revenue streams, from construction to energy and to transport, provide somewhat of a buffer against sector-specific downturns. However, even the mightiest machines can get bogged down. Economic uncertainties, particularly in some emerging markets, could throw a wrench in the works. Rising interest rates might slow construction projects, although I think interest rates are going to come down broadly around the world. That might actually be a good thing for construction. And then we got commodity prices. They continue to go up. It could also impact mining operations positively. If they go down, you get less mining, right? That's how it works. So what's the blueprint for Caterpillar's future here? Well, we've got robust global demand, tech innovation, strong market position. We have some economic headwinds, though, and falling interest rates often come hand in hand with slowing economic growth, and therefore maybe less construction. So are these guys poised for more gains, or is it too late? Well, if you believe in the long-term growth of global infrastructure and Caterpillar's ability to adapt to changing markets, the current share price might represent an interesting entry point. But of course, remember, the stock market, timing does matter. Yeah, they always say timing doesn't matter. You know what? It does. So I like Caterpillar. I must say, I think it's fundamentally a very good business. I think it's very well run. I think the numbers are impressive. It's a bit of a cyclical business. That's the only thing. So I would kind of look at, if we head into a bit of a cyclical downturn, then I think this could be something that could be worth nibbling at. But of course, do your own research. Now let's vault into the world of high finance. JP Morgan Chase, this banking giant, has been making waves. There is a lovely phrase from their CEO who says, "We don't just bank companies, we bank countries," which is true. They're not just a bank, they're a financial fortress, 4.1 trillion in assets. They've got the GDP of a small country tucked away in their little safes. But while other banks have been penny pinching, JP Morgan's been on a money minting spree. Their revenue in the last quarter hit 47 billion. And just staggering stuff. And what about the bottom line? Well, profits to shareholders reached 18 billion in the last quarter. That's just one quarter. How do they do it? Well, they've got more fingers and pies than a bakery on Thanksgiving. Investment banking, asset management. They're diversified with like a well-balanced portfolio. So what actually matters to shareholders? Well, earnings per share. $6.12 in 2024. That's a very, very impressive number. You might be thinking, Felix, these numbers are great, but what's the catch? Well, maybe you don't like bankers. I totally get that. I used to be one of them. All the viewers left right now, right? But they do face some challenges, of course. There's regulatory scrutiny, there's some economic headwinds, but they've also got opportunities in emerging technologies. They're expanding into all sorts of markets. And if you look at their stock price, well, it's been leaving kind of a trail of breadcrumbs for us. Currently trading at around $220. This stock has charted an impressive course, navigating through choppy markets and delivering a 29, almost 30% year-to-date return. The real question is, have we discovered a hidden gem, or is it just too late for this party to keep going? While many financial institutions have been treading water, JP Morgan has been riding the wave like a seasoned sailor. Its performance has significantly outpaced the S&P year to date, leaving many of its peers in its wake. So how do they do it? Dominance. Biggest bank out there, that matters. Biggest bank in the US, really. Most influential bank in the US, really. They have the inside track to pretty much every government in the world. Every regulator is licking their paws and kissing their feet. And once you are that dominant of a position, it's very likely you stay there. Unless you do something really, really stupid, in which case the governments will bail you out. So I quite like JP Morgan. I'm not generally a big fan of banks, but I think this is probably the only bank that's actually worth investing in. Now, of course, there are risks, economic uncertainties, regulatory challenges, and, there could be tech disruption that could, replace JP Morgan and all of that. But if you look at their balance sheet and their revenue streams being diversified, I think JP Morgan will be just fine and will be here for another 100 years or so. If we see a little bit of a dip in the banking sector over the next few weeks, it could be an interesting entry point to start nibbling at something like this. So we've looked at here the turbulent skies of Delta, which I particularly disliked, to the mountains of Caterpillar, which I'm much more of a fan of, and then the complex global finance whatnot with JP Morgan Chase, which I think is probably the only bank out there worth investing in. Each of these companies are, they have challenges, they have opportunities. I think JP Morgan and Caterpillar are better positioned than just the airline industry generally. I think it's a horror show. So what do we learn from this? It's all about diversification. It's also about timing. So as we potentially face more economic headwinds, these companies from different sectors could provide a more balanced approach than just being in, Nvidia or Palantir or SoFi or whatever, which is the mistake that most retail investors make. So my hope here is to inspire you to look a little bit beyond the headline grabbing, sexy, whatever the latest thing is. And if you want to learn a little bit more about how we make money from our money, then come and join me next week. felixprehn.org/webinar. I'll teach you how we're up 80% so far this year. And I'm not promising you those results. I'm just promising you to show you how we do it, what we do, how we use rules to trade. And it's part of our mission to make 1 million people financially free. And if you want to join that gang of people, I'd love it. And if you enjoyed this video, share it with a friend. And I hope to see you on the next one. What if I told you there is a stock that's caught the attention of both Wall Street insiders and our esteemed members of Congress? You might be thinking, Felix,